Hi, welcome back to this my second data update for 2026. In this update, I want to look back at 2025 and what US equities did during the year. And if you ask me to describe what equities did in 2025 in the US, I'm reminded of a James Bond movie. And every single James Bond movie, in fact, starts with the first 5 minutes of complete mayhem, right? Shooting, cars going off cliffs. You're convinced that James Bond will not make it, but you know it's a James Bond movie. He's going to make it and he's going to spend the next 2 hours being James Bond. That's what US equities look like in 2025. A thriller minute, car crashes, gunfights. At the end of the process, US equities come out looking pretty good. So I want to look back at the year and look at what the year delivered to us as investors. I probably am not surprising if I say it was a year of stunning news. Not just bad news about companies or about economies, but news that shook the foundations of an economic world order that has stood since the end of the Second World War, with the US at its center, global trade. All of those things saw the frictions that you would expect to see when you have chaos introduced into the game. In fact, you were the kind of person who just read the news. Let's suppose you were completely blanked off from financial markets. You had no idea what was going on. You read just the news stories through the year. And I'd asked you at the end of 2025, given all the news you've been reading this year, what do you think stocks did this year? I'll wager. You'd have told me it was going to be a bad year. But stocks surprised again? They delivered solid year returns. And I want to both look back at 2025 and then look forward to 2026, given what's happened. So let's set the stage. Let's look back at 2025, and I'm going to focus on two indices. This post, I'm going to focus on US equities, and the future one, I look at global equities. I looked at the S&P 500 and the NASDAQ from December 31st to 2024 to December 31st to 2025. If you look at the entire year, the S&P 500 went from 5881.6 to 6845.5. About a 16% rise. It's pretty good, right? But take a look at what happened during the course of the year. Started off fairly well first couple of weeks, and then we went into a period where clearly stocks were struggling. Late, February, even March. And then in the first week of April, if you remember, the world broke loose. Liberation Day, massive tariffs nobody expected. Stocks in those first 10 days of April felt the effects. In fact, April 11th of 2025 was the low for the day for the S&P 500 and the Nasdaq. And if you look at the course of the year started off with the S&P 500 doing better than the Nasdaq. Tech stocks finally were underperforming. But by September, tech stock had come back. They had recouped their regular place at the top of the table here. And the last quarter was a pretty stagnant one. Neither the S&P 500 nor the Nasdaq did that well. So ups and downs, but over the course of the year, the S&P 500 had a pretty solid year. How solid? If you focus just on price change, they delivered about a 16.39% price appreciation. But there were dividends during the course of the year. They were small. As a percentage of price, the dividend yield was 1.34% based on the level of the index at the start of the year. You add those two numbers up, you effectively get the return for 2025. I know there's a rounding issue, so it doesn't look like the numbers add up, but trust me, it's a 17.72% return. Now, I have to tell you that the dividends I used were the estimated dividends through December because the last quarter of dividends is still playing out. I took the first three quarters and made an estimate. So that number could shift, but it's not going to shift by much, by 0.03%, 0.04%, 17.72%. That looks pretty good, right? But let's look at it in historical perspective. Where does 2025 fall in the larger context of US equity returns? You might be aware that on my webpage, I maintained historical data for US stocks going back to 1928. So I went back to the data set and I looked at the annual returns every year from 1928 to 2025. That's 98 years of data. So what you see is a distribution of returns. And as you can see, the 2025 return fell almost exactly in the middle. It was the 45th best year out of the 98 years. So a little better than the usual, but not by much. Have there been better years? Yes. Have there been worse? Sure. In fact, in 26 out of the 98 years, US stocks delivered negative returns, and that wasn't the case last year. The worst year for stocks was 1931, minus 43.84%. That was the Great Depression. The best year was 1954. The median year is 15.22%. And in 2028, 25, you did better than the median. It was a better than average year. But what made it even more impressive was we were coming off two really good years where returns were greater than 20% in 2023 and 2024. This 3 year stretch was the longest stretch since the 1990s, where stocks delivered returns higher than the median historically. It's been a really good 3 year stretch where the total returns have been about 86.5%. So in the aggregate, stocks did well, but let's start slicing and dicing. US equities never spread their spoils evenly. Some sectors do well, some sectors do badly. So let's take a look at 2025 and the winners and losers. The biggest winner was communication services. Now, you have to remember that two of the Mag 7 stocks are in the communication services sector. So that might be one reason you see that, but it's a 30.6% return, the best performing sector. And these are S&P sectors, so basically I'm following the same script, putting companies where they put them in the sector. Second best, you're probably not going to be surprised, is technology, 23.65%. What are the worst performing sectors? Real estate and consumer staples, both around 2.3 to 2.5%. You can see the divergence, and you can see then why your portfolio last year might not have looked that good if you were not in technology, not in communication services. Overall, US stocks added $10.02 billion in value. Tech companies alone added 4.2 billion. They were the biggest winners in dollar value terms. But overall, it was a year where returns were better in some sectors than in others. Now, of course, the problem with sectors is they're very broad. There are lots of different industries. So on my webpage again, and if you want to see the details, you can check them out. I computed the returns for 2025 by industry group. I have 95 different industry groups, and then I ranked them from best to worst. So here are the best performing industries in 2025 and the worst performing ones. The best performing industry in 2025 was precious metals. Are you surprised? You know what gold prices did last year, right? They shot through the roof, over $4,000. Precious metals are riding the tailwind of all of that rise in gold and silver and other precious metals. Energy companies did pretty well, including coal. So it wasn't just green, it was good. So before you get too excited about the green energy, coal's in there too. A couple of technology sector industries in there. Overall, you can see that some industries delivered 40, 50, 60% returns. But at the other end of the spectrum, there were some real laggards. Chemicals, alcoholic beverages, household products, a lot of stuff that you think of as solid middle of the ground industries had a tough time. Food processing didn't do that well in 2025. Again, spoils are being spread widely and divergency across the market. While I was with my data, I also, so this is across all US stocks, I decided to check out two premia from the last century. I'm not going to try to be mysterious, but in the 20th century, two of the most widely backed premium was one was called the small cap premium. That in the 20th century, small cap stocks on average delivered 5, 6, 7% more on an annual basis after adjusting for risk than large cap stocks. It's a small cap premium. So people were advised in the late 80s and the late 90s to invest more in small cap stocks. The other is the value premium, where low price to book companies, after controlling for risk, earn much more than high price to book companies. This is at the basis for the value myth that value stocks beat growth stocks. We do know in the 21st century, both the small cap premium and the value premium have come under assault. I've written about this before, but there's been no small cap premium since 1981. It seems to have disappeared. And the value premium seems to have dissipated, especially in the last 15 years, high price earnings and high price to book stocks have outperformed low price earnings and low price to book stocks. In 2025, you got at least a partial rebound on both premiums. Small cap stocks finally outperform large cap stocks, earning significantly more than large cap stocks. Low price to book stocks outperform high price to book stocks, 8.1% higher returns. Does this mean the small cap premium, the value premium are back? I don't think so, but I do think we're returning to some steady state. In fact, what steady state? Small caps are going to win some years, large cap. I think the 20th century where small caps consistently won, done. We're going to see much more back and forth between these. Let's wait and see. But 2025 saw an interesting reversal back to a more steady state on both effects. Finally, you can't talk about US stocks without talking about the Mag 7, right? So in this table, I looked at the Mag 7 broken down by company. We bundled them all together, but they're very different companies. And in 2025, collectively, they did well, 22.4% return, adding almost, and if you think of the added value, adding another, in the aggregate, almost four, and I'll talk about the exact, almost $4 trillion. Look, I almost said billion. I'm so unused to saying trillion. 4 trillion in market cap, and the return was 22.36% in the aggregate. But if you look at the individual companies, again, you can see the divergence. Two of the Mag 7, NVIDIA and Alphabet, carried the Mag 7. NVIDIA was up 38%, following great years in the previous two. Alphabet was up even more, 63%. Apple and Amazon had returns which were much more modest, single-digit returns. So if you owned only two of the Mag 7 last year, I hope it was NVIDIA and Alphabet and not Apple and Amazon, because clearly returns were widely divergent. But it is true. Collectively, the Mag 7 have carried the market for the last few years. So this table, I wanted to see by how much. So I went back to 2014. In 2014, what we call the Mag 7 had a collective market cap of 2.4 trillion. It was only 11% of all US equities. Take a look at 2019. In that 5-year period, the Mag 7 went from 2.4 trillion to 11.9 trillion. They added 9.5 trillion in market cap, and they rose from 11% of all US equities to 24%. A third of the increase in that 5-year period of total market cap came from the Mag 7. And every year since, the Mag 7 is the tail that wags the stock market dog. In every single year, if you look at how much of the change in value came from the Mag 7, it's 30, 40, 50%. And in bad years, guess who's causing the badness? In 2020, if you look at the first quarter of 2025, for instance, the Mag 7 were down 2.6 trillion, and they alone accounted for 86% of the drop in US equities. So it's not just one-sided, it's collectively driving US equities. Across all of 2025, the Mag 7 was up $3.94 trillion. And as a percentage of the total US equity market, it accounted for 39%. Seven stocks accounted for 39% of the increase in market cap of all 6,000 publicly traded US equities. I'm not going to overdo it. US equity markets have always been top heavy. This is just unusual to have the same top seven carry a market for so long. So, with that said, let's stop the postmortem. Let's stop looking backwards, because nothing more to be gained by looking at 2025. Let's see where we are at the start of 2026. I know there are many who look at the last 3 years of great returns and we're due for a correction. It's kind of a lazy way of predicting a correction, but I get it, right? We've had a good run. Let's have a cleanup correction coming. The other is the second year of a presidential term. Historically, it's not been a good year for stocks. Bad things are coming down the pipe. So that's the second argument you're hearing. But the most common argument you're hearing for why people think stocks are overpriced is by using that metric that is perhaps still the most widely used metric in stocks, which is the PE ratio. In this graph, I've actually graphed out the PE ratio for US stocks going back to 1960. You're saying, why the three different lines? Because I've computed three versions of PE. One is the trailing PE, where I take the level of the index in 2025 divided by the earnings in the last 12 months, and I do that across time. The trailing PE at the start of 2026 was about 25.2, much higher than it's been historically. Problem people have with trailing PE, though, they say, look, what if last year's earnings is unusual? What if I averaged our earnings? That's called a normalized PE, where you take a 10-year average of earnings. That number is 37.14. Again, much higher than it's been historically. And when you push a normalized P and use a 10-year average, people then say, okay, what about inflation? Because earnings from 10 years supposed to be adjusted for inflation. So if you take the 10-year average and adjust the earnings from earlier years for inflation, you have, of course, the Schiller P or K. And at 32.4, that number too is higher than history. I'll be quite honest, I don't see much gain by doing these variations in P because the story remains the same on every version of P. Clearly, we're at levels higher than we've been historically. So does that mean that stocks are overpriced? We should go and sell them? Here's my problem with the PE ratio. If you use any of these versions of PE ratio, they have signaled that stocks are overpriced for most of the last 15 years. You'd have been out of equities since 2012 or 2013 if you'd watched the signal. So clearly there's a lot of noise in this signal. So let's look at what else can explain. So, other than the fact that people have gone crazy, they've become irrational, might explain why the PE ratios have risen. One is, so the PE argument is, it's higher than it's been. You got to get out of equities, but very noisy. But what is the basis for pushing back? Because there has to be some pushback if it's that noisy. How have US equities avoided that gravitational pull? Here's one reason. US companies have become earnings machines. What am I talking about? If you go back all the way to 1999, graph out the earnings on the S&P 500 companies, and you can see they've gone from 56 to 255.6. It's true, stock price up 420% this century. But guess what? They've not just risen without a good reason. Earnings are up 355%. Earnings have, for whatever reason, companies have been able to generate more profits. I know the cynics in you say they're playing accounting tricks, and some companies do, but in the aggregate, can you explain the change just by accounting tricks? Not only have earnings have had this growth path, they've also, for whatever reason, become more stable. In what sense? You've had only three down years in this century. One was 2001, the dot-com bust. The second was 2008-9, when you had the correction for the dot-com, for the 2008 crisis. 2020, most of us remember why, the COVID hit. In 22 out of the 25 years, earnings have gone up. Earnings have become, there's growth in earnings, and you also seem to have, I mean, if you're stepping back and explaining this, US companies have not just become more profitable, they become more resilient. They've been able to maintain their profits through many crises, economic slowdowns, global shocks. And that's got to be part of how you price US equities as well, right? The other side of the story that also needs to be brought in is US companies have also become cash machines in terms of returning cash. That's true. They're more likely to return cash in the form of dividend, in the form of buybacks and dividends. So the red portion of the graph is the buybacks every year. But if you look at the cash yield, which is dividends plus buybacks, the US companies have actually, the cash yield is not that different from what it was 20, 25, 30 years ago. It used to be just dividends. The dividend yield used to be 3 or 4%. Dividend yield alone has dropped back to historic lows, but augmented by buybacks, US companies are returning dramatically large amounts of cash. Last year, the S&P 500 alone, the companies the S&P 500 returned more than $1 trillion in buybacks. You've got growing earnings, accompanied with more stability in those earnings and these massive cash returns in the form of buybacks. There's a story to be told for why US equities now should be worth a lot. Whether they should be worth as much as they are is a different question. But the notion that we're in a bubble just because stocks have gone up a lot is, I think, easily pushed back on because you've this other stuff going on. So how do you break this tie? Here's my favorite device, and you've seen it before. You need a metric that captures the pricing of stocks. Obviously, higher prices are tougher to justify, the earnings and the earnings growth, the cash being returned, but you also need to bring in your alternative to stocks, which is what do you make on T-bonds? Wouldn't it be neat if we could get a metric that did all of that? I think I have one for you. It's called the implied equity risk premium. And here's what I'm going to do. I'm going to take the level of the index start of 2026. It was 6,845.5. That's what the S&P 500 was. I take the cash flows on the index for the trailing 12 months coming into 2026, which is 198.99. And here you might get a little suspicious and skeptical. I need to project out what those cash flows will be in the future. So I look to see what top-down analysts who forecast aggregate earnings for the S&P 500 are forecasting as growth in S&P 500 earnings. And the start of 2026, they were pretty optimistic, 10.5% growth a year. And before you, say, poo-poo that and say, you know what, they don't know what they're talking about. This aggregate, these earnings estimates, if you go back at the last 25 years, these they've been they've overshot and undershot. There's been no bias. They've been wrong, but they've been wrong in both directions. I took that growth and put it into the last year's buybacks, 198.99, growing at 10.5%. And at the end of the year, the fifth year, which in this case is 2030, I said, look, you can't keep growing at this rate if you're the 500 biggest companies in the US. I dropped the growth rate back down to 4.18%, suspiciously precise, right? But that's actually my T-bond rate. In the long term, I'm assuming the nominal growth in the economy will converge on that. Now, it's simplistic. You've got cash flows in the aggregate. I look for an internal rate of return. I solve for that discount rate that makes the present value of my cash flows equal to the level of the index. The number I get is 8.41%. You see, what does that tell me? At the start of 26, I don't care what you hoped you would make, what you thought you would make, what you prayed you would make, what models tell you should make. Given what you paid for stocks, you can expect to make 8.41% a year. Now, T-bonds were delivering 4.18%. And if you take the difference, you come up with the difference of 4.23%. Now, until 2024, that's where I used to stop. But in 2025, if you remember, life got messier for people using T-bonds because the rating for the US got dropped from AAA, at least the Moody's was the last holdout, to AA1. The default spread on the AA1 rated bond is about 0.23%. So you could actually argue that a dollar risk-free rate is 3.95%. So if you take the 8.41% and you net out that 3.95%, you come up with an implied equity risk premium of 4.46%. If you don't like that adjustment and you don't make the adjustment, it's 4.23%. You say, how does this help me decide whether stocks are cheap or expensive? When you look at that premium, 4.5%, I asked you, is that a number that's too high, too low, or just right? Let's play through. Let's suppose you say, hey, 4.5% is too low. We live in a world full of risks. It should be 6%. What are you telling me? You're telling me stocks are overpriced. So that premium looks too low to you. Stocks are overpriced. If you look at the 4.5%, say, I'd be happy making 4.5% more than something risk-free in this world. You're telling me stocks are underpriced, that they have more room to grow. And if you look at the 4.4.5% and say, that's about where I would want to be, you're telling me stocks are correctly priced. You're saying, how the heck am I going to make a judgment as to whether that number is high, low, or where it should be? I'll give you some guidance. I've been computing these implied equity risk premiums for a long time. And in this graph, I have a graph of the implied equity risk premium for US equities going back to 1960. The 70s inflation did wreaked havoc on the equity risk premium. The 1999 bubble, the risk premium dropped to 2.05%. That's a bubble. When the premium drops to numbers, I can't justify that. 2.05% clearly, it's tough to justify. But 4.23%, which is this premium you get without netting out this, is pretty close to that equity risk went 4.25% across the, we're almost right at the average for the last 65 years. So if you're a Goldilocks person, you think this is about where we should be, or a non-market timer, you're feeling pretty good, right? Look, the premium is roughly where the historical average is. There's something here for everybody, though. If you're bearish, though, I'll give you the story you're telling. You're saying, look, since 2006, we've been in this crisis-driven world. Premiums have been 5%, 5.2%. This premium looks low relative. You're making an argument that stocks are overpriced, but it's not an argument for a bubble yet, right? It's not 2.05%. This is perhaps the reason I'm most skeptical of bubble talk, because bubbles would show a number much lower for the equity risk premium. So you can download the data, play with it, but that's really my metric going forward. And as you know, I do compute this number start of every month, and I'll keep doing it all through 2026 to see if red flags start going on. So here's the bottom line. US equities had a good year in 2025, but that doesn't mean that there is no source of worry. Clearly, there was success, especially around AI. And there's a question of can US companies continue to do what they've done for much of the century, deliver earnings growth and return cash flows in the face of a tsunami of bad news that's coming at them. Now, I've made this confession before, and I have no shame for doing it. I'm not a market timer. But at the same time, I've done my own version of market timing, because when I sell a stock and I get cash, I usually invest it back into stocks, and I haven't been doing that now for about 13 months. I have a lot more cash than I usually do. And toward the end of last year, I did mention collectibles. Maybe in a later post, I'll talk about whether there's some opportunity there. But, let me put it this way. I am concerned, but I'm concerned about equities pretty much every year. I think, to me, I think we've had a good run, and the healthiest thing that for the market might be to have an average year, return 8 to 9%. No, because that'll allow things to consolidate, the excess to kind of fade. I'm not making that as a prediction. It's almost certainly not going to be exactly that number, but that might be the best thing for the market. But there's a real chance that all those bad news stories from last year finally will start to find their way to the bottom line. That earnings will be affected and cash flows will then be impacted. That, I think, is the bigger risk for stocks. I hope you found the session useful, and I thank you very much for listening.